VA loan assumptions. So the topic is hot right now, obviously, because we've seen interest rates jump so high, right? And with these higher interest rates, slow down our buyer demand, and we got to get creative and think of, some other ways to get people into homes. And even with the forecasted projection of interest rates coming down next month, or sorry, not next month, next year, I don't think we're still going to be in a place where VA loan assumptions are out of question. I think it's still going to be a very viable solution for some folks, because the expectation with the VA rates sometime in 2023 will be kind of mid to high fours, which will be a great breath of fresh air compared to where we are today. But when you compare it against some of these 2-point somethings or 3-point something rates that a lot of these VA loans have currently, still makes the VA loan assumption a pretty attractive thing for people. So who can assume an existing VA loan? This is an important one. A veteran, that's pretty obvious, I would say. A civilian, so any civilian can assume it. Some other ones that are interesting, separated spouse. So if someone is going through a divorce or separation, if there is an official separation legal document and or divorce is completed, you can do the assumption to the departing spouse, which is an interesting way to go about it. A child or family member. So this could be in the instance where someone was incapacitated or maybe even passed away. The loan can be assumed by a child or a family member. So what does the occupancy need to be? So this is in reference to the person assuming the loan. Owner occupied is required if we're transferring entitlement. And we'll touch on this a little bit more, but essentially going from, veteran to veteran, and we're going to swap entitlement and whose entitlement is on that house, then it's got to be owner occupied. It can be for an investment property. So the VA regulation does not stipulate that it cannot be for a VA or for investment property. It states that anybody can assume the VA loan. So there's nothing that prohibits it from actually being used as a investment property or a second home for that matter. So this could spark some ideas. I know a lot of you are investors yourself. So this could open up a window of opportunity for you personally to maybe go in and assume someone's VA loan as an investment property for yourself, but also for your clients. And I know some of you have, a great database of investor savvy people. So let's touch on that entitlement piece a little bit, because I feel that as we proceed through this year and the next year, and we see more and more of these VA entitlement or these VA loan assumptions happening, the lack of knowledge or education may put the departing veteran in a bad position. And what I mean by that is with regards to their entitlement. So a little history on what VA entitlement is for those that need a refresher. So the VA guarantees the loan up to 25% to the mortgage company, and that is termed as entitlement. So for every mortgage out there with a VA loan on it, 25% of the original mortgage amount is what entitlement charge is basically assigned to that veteran for having that loan on that house. So when we're talking about loan assumptions, if a veteran is coming to assume another veteran's loan, then what we want to try and ensure is that assuming veteran has enough entitlement available to take over this home loan that they're assuming and put their entitlement on it. So that way the departing veteran has his entitlement available to go buy another house. And I think this is where some people are going to stub their toe. And I think, unfortunately, some veterans who are selling, a few people join in. I think some people that are actually selling their house in an assumption process are not aware that their entitlement could also not come with them. And so it's going to take the proper advisement of the realtor to let them know this is a potential, right? So we want to make sure that we're advising these veterans that if they're going to allow their loan to be assumed, that they also have a plan thereafter, right? And their plan might be for them to go into an assisted living facility. They might be going into a retirement facility, moving in with family, or maybe they're getting enough cash proceeds where they're going to go put a big fat down payment, do a conventional loan on the next one, so they don't care about their entitlement. And that's okay. But we want to make sure that we're advising them correctly so that they understand what is available and what isn't. Any purchaser may qualify to assume a VA loan. However, if the veteran's entitlement is going to be restored, then we need another veteran to assume it. So as you guys are talking to clients that have this potential for letting their loan be assumed, make sure that you go through this conversation of entitlement and what their next plan is. Because if they're going to use that VA loan again, we want to try and probably narrow down their buyer to a veteran. Hopefully that makes sense. So how do you start this assumption process? So this is an interesting process because it's not very familiar with most people, and most lenders and most banks, most loan officers aren't aware of this process. And so I've only figured it out because I've studied on it, I've read up on it, and then went through a couple of them. So I've helped do a few of these VA loan assumptions. So the first thing is the loan, the departure residence loan, the loan being assumed, has to be current or will be brought current at the closing of the sales transaction. This is important language because as I surfed the internet and found other lenders' explanations of VA loan assumptions, all of them are saying it's got to be current first. And according to the VA handbook, this is the actual, I copied this language out of the VA handbook. So it can be brought current at the closing. So why that is super important is we had in the last couple of years, the ability for people to go into forbearance, if you guys remember, right? And some of these folks went into forbearance and then went into a modification on their mortgage, and there is an arrearage due when that thing closes. Or some of them are still in the forbearance period and they haven't come out of it yet, or they haven't finished the negotiation on the modification. So there is the ability here for someone to get out of this loan and through the process of the transaction, bring it current. So an important understanding of language there. Seller is going to need to provide a recent mortgage statement to the buyer. Obviously, we got to know what we're assuming, right? And I think this level of clarity is probably a given, but just in case you got a stickler for a client that's the seller, we need to make sure that they're able to provide a mortgage statement and not one from like 9 months ago, the most recent one. So if they threw it away, log in online and print out a new one. We got to know what we're getting into. And at this point, which is part of what we're going to talk about today, is the buyer will need to apply and get pre-approved for the second mortgage. So what I have come in to help do is provide that second mortgage to cover most of the gap between existing loan amount and what our new purchase price is going to be. There's going to be a gap there, right? We all realized a ton of equity growth the last couple of years, and these sellers are selling because they want to recoup that equity, right? So it's important that at this point, we've got a copy of the seller's mortgage statement, and now the buyer is going to apply and get pre-approved for that second mortgage. We need that mortgage statement on the existing loan so we can figure out debt ratios and stuff because they're going to be taking over that mortgage. The seller is going to need to contact their servicer that they are doing an assumption sale. Well, their servicer being the mortgage statement lender that they're getting every month in the mail. So it might be PennyMac or Wells Fargo or Freedom Mortgage. You know, those are some of the big ones out there. It could be Cenlar, but they're going to contact that 800 number and they're just going to let that customer service rep know that they're selling their house. They're going to allow their loan to be assumed, and they need to get the wheels in motion with their current lender. So the current lender is going to give them basically an authorization form, right, to sign. So that lender is not going to release any information to the potential buyer without this form signed, just saying, hey, I'm the seller, I'm letting this buyer, and they'll have to name who the potential buyer is, have access to any of the mortgage information they need. So pretty simple, but it's an important step. And then the buyer, provided, everything checks out with the pre-approval for the second, and everyone wants to move forward, and we've got a contract, then the buyer will need to initiate their loan approval process with the servicer. So I am not, and no other loan officer is involved in the actual assumption loan piece. I'm involved in the second mortgage for some of that gap financing, but I actually don't participate in this piece. So the servicing lender is your quote unquote loan officer on the first mortgage for your process, right? So the buyer will have to make contact with the servicer, say, hey, I'm assuming this loan. You've already got the signed authorization from the Joneses. I'm going to assume their loan. What do you need from me? And it's a traditional kind of loan package, right? They're going to look at last 30 days pay stubs, last 2 months bank statements, last 2 years tax returns, W-2s, pull their credit, look at their ratios, all the same stuff we would do for any other mortgage. They're going to do the same thing as well to determine if they're qualified for that. Now, the servicer, they need to order a certificate of eligibility. So assuming that the assumer or the buyer is a veteran, they need to quickly order that certificate of eligibility, making sure that we don't leave our departing veteran in a bad place, right? So we want to double check this. And especially if you know the buyer is a vet, we want to make sure that that servicer is ordering the certificate of eligibility. And according to the VA, the servicer is also supposed to order an appraisal. And the deals that I've been in, I haven't been privy to whether or not they did order a VA appraisal or not. Technically, they're supposed to, but that's kind of between them and the VA. So how long does this process take? I bet some of you have talked to other lenders and heard a wide discrepancy of how long this takes. And I certainly have heard it from other realtors across the nation who have told me some lenders told them 90 days, some told them 6 months, some told them 60 days. It varies from everyone they heard, but no one can really say with any confirmation as to what the actual time frame is. So one thing that we have to understand is that these servicing companies, right? You get a Cenlar or a Freedom or a Loan Depot or some of these guys. And even though we're familiar with those names on the retail side, because they do have retail parts of their business that go out and originate mortgages, the entity that we're dealing with is the servicing part, the customer service, the call center. That's who we're dealing with. So we have to remember that this is not, 2 floors stacked with 200 agents that know exactly how to originate a loan. We've probably got in, the building of 200 call center folks, we've probably got 1 or 2 people that even have an inkling of how to do a mortgage. So we have to know that kind of going in so we can set not only our clients' expectations, but our own expectations as well going into this. You're not going to be dealing with a seasoned loan officer that can just rock this thing out. So there's got to be, kind of a diminished expectation there, sadly. But the application process is no different than applying for any other regular mortgage. So it's not any sort of rocket science or different format that the servicer needs to go through in order to make this happen. And then the second mortgage that we're providing will close simultaneously with the first. So there will be a point where I get involved with the assuming lender because we're going to need their loan estimates and some information from them so we can get things all the way to the closing and obviously coincide timelines. So my advice to the buyers is every time I just get a legal pad specifically for this purpose is what I tell everybody. Write down the date and when you call that servicer, who you spoke to, what their extension was, and basically the bullet points of that conversation. Because remember, we're dealing with a big army of call center folks, not some rock star loan officer. So oftentimes these files get pushed around and moved to various people within these large organizations. And some of the people take notes and put them in the system. Some don't read them, right? So you have all this disparity, and oftentimes reaching the same person again and again can be a challenge to get the same person over and over. So take notes. And one experience I can share with you, the first loan assumption that I did a second on earlier this year, the servicing lender was Wells Fargo. And out of the gate, they were moving actually at a really good clip, but they hit a moment, and I'm sure you guys are all familiar when dealing with the big banks and credit unions, they hit a moment where it was radio silence and no one could reach them and they weren't talking to anybody. And the struggle with that was we're coming up on a closing date and everything had been submitted that the clients needed to submit. So we're really just waiting for kind of the final couple of steps. Fortunately, they took my advice and made copious notes of who they spoke to every time. And now we had to play kind of the corporate ladder game and start going up to the manager and the supervisor and the department manager and so on and so forth to eventually rattle the tree enough to get the original person to start taking action again and finish the loan. So that's why I say it's so important to take notes and push, because you can get into kind of these bureaucratic black holes because some of these companies are huge in size and got a gazillion employees. So you can get lost in the shuffle. So it's super, super important just to be really detailed. Now, as we talk about time frame, all right, now you're going to hear some of these lenders tell you 90 days, 30 days, 60 days, all these different things. The VA actually has language in the VA handbook, and they talk about two different things here, but essentially they're saying that the lender processing the assumption has 30 calendar days after receiving the complete application package. So now if the buyer's dragging their feet on a document or two, the 30-day clock can't really start. So it's got to be complete. They got to have everything in. But from there, they have a 30-day window per the VA. There isn't a mechanism for kind of thumping the assumption lender if they're moving slower. But what I will tell you in the handout I'm going to send to everybody who attended today, I'm going to send you guys a handout with the excerpt from the VA handbook that talks about this so that you can leverage this. And potentially you may even have to call the VA Regional Loan Center if you get in a situation where you're pushing or beyond that 30-day window. I've heard some nightmare stories of some of these assumptions taking 4 months, which is not ideal. None of us want to be in that. And the VA has language against that. But the assuming lender and their call center person probably is completely unaware of what the VA handbook says. They probably never even looked at it. So it's upon us as the professionals who know this really well to provide this information to them so that we can help get our clients to the finish line and take great care of them. So what charges and fees come along with these assumption loans? The loan application approval process, they can charge a fee for processing the loan, the servicing lender. So they can charge up to $300 and they can charge for the cost of the credit report. If the deal doesn't go through, they can be refunded $50. Essentially, they're going to be on the hook for $300 for processing plus the cost of the credit report. So anywhere from $30 to $50 probably for that. So they're going to be $300 to $350 in just processor or lender fees. The other thing that they are going to be required to pay is a VA funding fee. So the VA funding fee on a loan assumption is 0.5%. So you take the loan balance times 0.5, and that will tell you in dollars what the funding fee is going to be. This cannot be financed into the loan. And I know we're all used to that with purchases and refinances and things like that with the VA funding fee. But in this instance, it cannot be financed and it must be paid in cash at the time of transfer title. So when we close. All right. So who wants to see the math on this? So I'll show you the math, and I built a calculator that I'm going to share with all you guys to make this more simple. But as I walk you through this, the math that I'm going to explain to you is in the example of we've got someone selling their house for a really great price, and their mortgage is a lot lower than that. So they're looking to get a couple $100,000 in equity. And that's kind of a typical scenario today, right? So here's how the math is going to work for being able to provide this gap financing. The buyer must have 10% down payment. I don't have a zero down solution for the assumption loan. So the client buying the house is going to need 10% down payment. So to figure that out, purchase price times 10% is going to equal your required down payment. We can't get around that. The second mortgage, which can be a HELOC, home equity line of credit, or a fixed second, can cover the difference between the first mortgage balance, the first loan balance, and that gap up to that down payment 10% figure. So it's in mortgage speak, we're considering this a 90% CLTV, which CLTV stands for combined loan to value. We're all used to just regular loan to value, like loan amount divided by purchase price, loan to value, or appraised value, loan to value. So this is combined loan to value, which means all mortgages totaled divided by our value, right? So first loan balance plus the second loan balance can only equal up to 90% of that purchase price. So for those who want to see kind of a visual, we got the green existing loan balance. We're going to have a second mortgage in there for a piece, and then we got that down payment for the 10%. For our product, the second mortgage must be a minimum of $50,000. And no, the closing costs can't be rolled in. I've been asked that a lot, but $50,000 is the minimum. So there are instances where I'm not going to be able to assist, right? Because the dollars are too small. I had one yesterday. I was talking with a guy and the math just didn't work. We couldn't get a scenario where we could make the second mortgage $50,000. Just small purchase prices, small market and everything else. So it's got to be at least $50,000 or more. So here's what it looks like. And I'll switch over to the calculator in a second. But this is an example. And I put on this tool for you guys these big red arrows and the word enter. So these are the data points that you're going to manually input on this spreadsheet that I'll send you. So you'll put in your purchase price and what the balance is on the mortgage we're assuming, and the rest of it will calculate itself. You'll see here the combined loan to value max is 90% in red, and then on the bottom here in green, the dollars for down payment in this example are $85,000. Now to the right, this will automatically calculate for you guys. And one thing I will tell you is second mortgages are really sensitive to the CLTV, debt ratio, and credit score. So any of those variables can affect the interest rate on this greatly. So if we look in the yellow column, this is a home equity line of credit. For this same scenario, we're assuming a 740 credit score. So a lower credit score is going to jack this rate up. A better credit score might bring it down a little. So in this example, 740 credit score, we're going to 90% CLTV. Now, if they had a bigger down payment, this interest rate would reduce. But we're assuming they're only coming with the 10% down. So it's at a 13% rate. But the payment on a home equity line of credit, the required payment is interest only. So in this example, it's $2,349 a month to finance 200 and almost 17 grand, which you'll see over here on the left. So the great part about the equity line, as you guys are well aware of, as they pay that down, it's a line of credit. They can reuse it again. So for those clients who are coming in and maybe they work in a commissioned environment like we do, and they might get big chunks of money, this can be a great tool for them, or they're expecting a sale of another property they own, or an inheritance, or any bonus or something like that. The equity line of credit can be a really valuable tool for them because they can continue to reuse it. Now, the interest only period and the draw period, where they can draw and pay down and draw and pay down, is the first 10 years. After that, it goes into a 20-year fixed mortgage. So principal and interest payments will begin starting year 11. So that's how the equity line of credit works. And I put some asterisks here so you guys can have an idea of where some of the adjustments are going to be. So if this was a deal we're doing in New Jersey or Virginia, there's a 0.5 point add-on for the rate. I don't know why, that's just their thing. If we need to push our debt ratio beyond 45% with a limit of 50, they're going to add another 0.5 point to the rate for that. And I just put an asterisk here at the bottom. The minimum line amount is 50,000. I can't do 49. I can't do 24. We can only do 50 or above. But then if you look over into this blue section, so this is a fixed second. We have the ability to change the amortization period. So right now I set this at a 30-year amortization because that'll provide the lowest payment, but we can do 20 years and we can do 10 years. So it's on this exact same scenario, assuming a 740 credit score. The interest rate is a little higher on the fixed. Now the HELOCs are variable. So when you hear about the Fed changing the rates, it affects that directly. Over here, it's going to be fixed at wherever we get it fixed at. So in this example, it's 14.1%. Their payment is $2,586 a month. Now you'll see some additional add-ons here. There's quite a few more for a fixed mortgage. I won't read all of them to you. One of the interesting points is the bottom one. If they have a loan amount that's less than 60 grand, 59.9, but greater than 25, so 25 is the minimum on the fixed, it's a 0.25 point add-on. So if you do have a scenario where we don't quite have enough to hit the 50,000, we could do something. If they had 25 or they had 30, we could do the fixed second to help bridge some of that gap for them. So hopefully that makes sense. I know we got some questions coming in on the chat here, and I'll get to those as we get to the end. And we can run through some scenarios on this calculator as well. But here's the marketing strategy. And I'm sure, some of your wheels are probably already turning on like, okay, there could be some real opportunity here to get some business. And I know it's been slow the last couple months, and the first quarter of next year, probably not going to be crazy good either. Hopefully a little better, but it's not going to be off the charts like we would wish. So we got to do some things to generate some business, right? So this is a really cool opportunity with these assumptions, and you could market towards the FHA as well. But you could pull a list in your market of people who have VA loans. So you can use your title company to help you pull this. Or there's a website called Property Radar, and Property Radar will provide you a little more information. You can get some phone numbers, some email addresses. So for marketing purposes, you got to pay for it, but might be a good solution for you. And then obviously you have all the various tactics on how you can market to this, right? You could hit them with mailers, hit them with calls if you get the phone number information, email, same thing, or go door knocking. If you're really savvy and you've got all this data, email, zip codes, all that stuff, you can do some geofencing on Facebook, which is another really trick way to get your message out there. But I think ultimately, as you market towards this, if you do decide to market towards this, being a veteran and, working with so many vets, the less salesy your material is and your pitch, the more well received it's going to be. So I would have a message, something along the lines of, hey, look, what we're trying to do is help other veterans coming into this area who might be on PCS orders or active duty military who have PCS orders coming into this area. You have a VA loan. You probably have a crazy good rate. If you're ever interested in selling your home, the VA will allow that loan to be assumed. So here's some information on it. And that can be kind of the oration of your messaging in your own words, obviously, to get some interest and get some bites. If you're doing mail marketing, and those that haven't done it or have done it, you gotta stay after it. About 6 months is what the rule of thumb is on mail marketing to get some return on that. Offer an incentive. Hey, if they know somebody and can refer you someone who has a VA loan that might be moving, or they might be getting orders across the country and they got to vacate, you could offer an incentive to those folks for those referrals. And in all of this marketing, you could just be asking for referrals and maybe not their direct business, which is kind of a sly way to go about it too. But most importantly, is you've got to be really consistent with that marketing and that message if you're going to pick it up. But I think it's a home run, especially if you already farm a particular area. You could adjust your farm and do an additional flyer, or if you're just hitting a whole zip code, you could just start mentioning this opportunity with assumptions, because not only are you trying to dig up some listings, but you might also pull some really good buyer leads as a result of, those mailings hitting the right folks. Going to go through the chat here, answer some questions. And if you have a question you want to ask, go ahead and raise your hand. It's down on the bottom there. You'll see reactions and you can raise your hand. There are exemptions to the VA funding fee. So that's a really good question. If you have a predisposed disability that's coming forward, the VA will waive it. Or if you already have a disability rating, it will be waived. Or if you're a Purple Heart recipient, then the VA funding fee will be waived. If you're average Joe citizen and you're assuming this VA loan, you don't have a way out of it. You got to pay it.
Hi, how you doing today, Jason?
Great. How are you?
Good. Yeah, so essentially, assumptions very similar, except for it sounds like there has to be an approval process through the lender. There's been a situation where I had a VA loan, and we were able to just essentially purchase the property subject to keeping the current loan in place and paying that loan, but taking title. And so it's definitely allowed, I think, but it's one thing it's frowned upon by the bank, where if the bank decides, hey, if they want to call the loan due, they could. However, most of the times they just want their money and they'll just take the payment. So I guess my question is, if I were to do a subject to keeping the current loan in place, could I get a second mortgage to, let's say, buy them out of their equity, right? So let's say they had 150K in equity and I wanted to take out a second mortgage to do that versus, on one of my deals, I just did a balloon payment where they were guaranteed their equity in 36 months.
Yeah, you could, as long as we can show the ownership transfer will be in your name at the time the second closes.
Okay.
Yeah.
Good to know.
Yeah. Good question.
Thank you.
Yeah, no problem. The 10% down payment, this is from Daniel. That's only if you're getting a second mortgage. Correct. They could also pay the cash difference, right? So the second mortgage solution is for those that don't have the cash funds available. But yeah, you can pay the difference. So if you got a $300,000 delta, they're selling a house, they got equity, they want to roll it over, slam dunk, no problem. And then you don't need me at all in that scenario, but you still got to deal with the lender that holds the current mortgage. Anybody else have questions that I can?
Jason, this is Mike. Less of a question, just more of a comment. Can you hear me okay?
Gotcha. Yeah.
I forgot to cover this yesterday, but keep in mind, I dealt with this with one of my assumptions. Just need to remind the buyers that the principal is going to continue to be paid down on the loan. So they have to keep in mind that the down payment requirement may change over the 4-month period, especially on these bigger houses. So I had that with mine, where he was hell-bent on the fact that the purchase price and original down was what he thought he was going to pay. And I told him there's what's called a assumed financing addendum that talks to the changing of the down payment during the escrow process.
That's a really good point. I'm glad you brought that up. So yeah, the one thing we have to remember, even though you guys will be structuring these as purchases, that mortgage that they're assuming is still live and it's still going. So if the assumption process, as Mike was mentioning, drags on and on and on, that homeowner is still making a payment every month, which is chipping away at that principal balance. So that principal balance is getting less. And our purchase price is not shrinking. So our purchase price is staying static and the equity is just continuing to grow little by little each month. So yeah, that down payment at the end could be higher as a result. Really, really good question or good comment. I'll show you guys also the spreadsheet, which I will email to all of you. Let's see. Hopefully you guys can all see this. Okay, good. You should all be able to see it. But see here, here's the calculator. So we could plug in a couple different scenarios here to get an idea of what it's at. This was an $850,000 purchase. This was a scenario I was actively working on and came up with these numbers. But, we could do something, not every market's going to be that way. So if we had a $500,000 and let's say we've got a 324 loan, here's what we'd be looking at in this scenario. $500,000 purchase price. Their down payment is going to be 50 grand. And we're guessing, right? The mortgage on the first they're assuming is 324,000, which is probably a pretty fair guess. And we'd have a proposed mortgage on the second of 126. So the total of both their mortgages would be 450,000 at the end of the day. And then here would be their payment on the HELOC and then on the fixed second, if they had a 740 credit score and so on and so forth. So I couldn't make this calculator to assume for a gazillion different credit scores because there's so many different brackets. As you get lower in credit score, just for your information, the more restrictive the combined loan to value will become. So, if they're in there at a 620 credit score, yes, we can do a second for them, but they're not going to get 90% combined loan to value financing because they're a greater risk. And second mortgage companies are in a riskier lien position to begin with. So they want to make sure that they have some level of protection, and credit scores kind of the best way that they can, predict how they're going to be repaid. Let's see, Daniel, he asked, could you cover how the entitlement gets transferred from the current owner to the buyer? Yeah, so assuming it's a veteran or someone with eligibility buying the house, taking over that mortgage, then the assuming lender is supposed to pull the certificate of eligibility on the buyer out of the gate as they're processing the loan package. Now, remember, I mentioned a lot of these assumption lender departments are, a handful of people that were just customer service reps. They may not be thinking about asking this because they might just be trying to pull credit and crunch numbers on debt ratios. So it's going to be important that probably the buyer, because they're the one speaking with them, helps bring this up if the assumption person doesn't. But they need to pull their certificate of eligibility to see if there's enough eligibility available. And then the assuming lender will send the correct paperwork into the VA for the transfer of entitlement. The veteran who is selling the house can also contact the VA when it's over and just confirm and ask for a restoration of entitlement. And unfortunately, they may run into situations where that assuming lender didn't do what they were supposed to. I hope not, but it could happen. So they might have some extra legwork to get done there, but that certificate of eligibility should be pulled at the beginning. Now, remember, if it's a civilian, no VA entitlement to their name didn't serve, and they go to assume this VA loan, that seller, the veteran, his entitlement is tied up on that house until that loan is paid off. So we just have to be extra careful with that. Now, it doesn't mean he can't use his VA again. He can. We can do the entitlement calculations to see how much VA loan he can get this next time around, because who knows, maybe he's getting, a great offer on his house and has a large equity component. He's going to get a bunch of cash and he's okay with having a sizable down payment on the next place. That doesn't preclude him from doing VA again. He doesn't only have to go conventional, but we got to do the math, see how much VA is available to him. But in the instance where you have someone selling maybe a higher priced or a higher loan amount home, let's say you've got a veteran selling a house in Carlsbad and his existing loan amount is $938,000 and he's going to go, buy something else in the San Diego market after that. Well, if his entitlement stays tied up on that house, because it's such a big loan amount and so much entitlement is attributed to it, that he's likely not going to have hardly any entitlement available to go do VA on the next home purchase. So, it's important that we are having that conversation with them, because the last thing we want to do is end up in hot water because someone didn't explain this to the client, right? And I can see, people coming after E&O insurance because they did this loan assumption. My realtor told me it was cool, and I went on to get the next place and my VA loan isn't available anymore. What the heck? So as much as it's a great tool, we have to make sure that we're advising properly on top of that. Renee asked, does the other veteran need to pay the 10% down and the 50 basis points fee? Yes. So it's 10% down payment because of the second mortgage, right? It won't let me finance 100. It'll only let me finance up to the 90. So that's the reason for the 10%. And then the half point funding fee, it's the VA's funding fee. They charge that same funding fee on VA IRRRLs when people do the streamline refis. It's that same funding fee amount. But if they're exempt, right, if they have a disability rating or a Purple Heart, then they can be exempted from that half point funding fee. But yeah, great question. Let's see. Anybody else have questions? I know we went over a lot.
Hey, Jason.
Yeah.
Hey, man. It's Jake Smoke. Hey, man. Question. So are there disclosures in the loan package regarding, basically stating that language that, hey, your VA is no longer available, disclosing the fine print?
I don't know.
For that example that you just gave? Yeah,
I don't know. To be honest with you. I haven't been privy to the closing document package on the assumption loan in the transactions that I've been involved in. So I've only seen the closing documents on the loan we're providing, which is that second mortgage, which has nothing to do with the VA loan technically.
Right.
So I don't know. My hunch is that there isn't anything. And the reason my hunch is that way is because, VA loans have been assumable since the beginning, but the active action on doing loan assumptions has not been very prevalent, hardly ever that we can remember. Right. So it's a hot topic now, and it's starting to see more stuff. So my guess is they haven't had enough, issue with it yet to warrant a special disclosure. And I bet you we'll see it. I bet you we're going to see something, because someone's going to get pissed on this entitlement and get pissed off.
This sounds, there's so many different variables that can go into play with this. I mean, it's no different in real estate, but it sounds like this is, especially in this state, it might be something where it's very, litigation might happen quite a bit.
Yeah. And I don't know, it might be worth maybe talking with our legal or your association's legal, just to see what their thought would be in this scenario, as far as maybe having a document that explains it to kind of protect you guys, right? Like, hey, we disclosed it. This came from the association. Their lawyers approved it, put their blessing on it. That might be something interesting to pursue for the group. Because I got to imagine at some point in the future, there's going to be some kind of kickback on that.
Right. All right. Thank you.
Yeah. Anybody else? Thoughts, questions? Had some really good questions here.
One other note, if I remember correctly, the funding fee can't be added to principal. So it has to be paid by the buyer up front, even though it's 0.5%, just another nuance to keep in mind.
Correct. Yeah. It cannot be financed, has to be paid cash at the close. So along with this recording, you guys, I'll send out the slide deck. I'll just put it all in a Google Drive so you guys can download it. So I'll put the slide deck in there. I'll also put the excerpt. I'll show you guys the excerpt I pulled from the VA handbook that explains the timing of this and what the VA says, that 30-day window. So you can see here, but I'll send this to you. It's a PDF. If you want me to take out the highlight marks, I can, but I'll send this to you guys as well. That just breaks this down. It talks about lenders with automatic authority and those without automatic authority. I wouldn't get yourselves overly concerned with that language, but basically, mortgage lenders have to go through a process of having automatic authority to approve, underwrite, and deliver loans to the VA, versus some haven't quite got that level of approval yet through the VA. So every deal they do, they have to send to the VA for their blessing first before they can deliver it, which is really all that means. But I'll include this So you get the slide deck. I'll send you the recording of this, the PDF, and I'll also send that Excel calculator that will help you with kind of figuring this stuff out, which would be a great tool for any potential buyers you guys have that, you know, are kind of thinking about this assumption process. Now we know the why behind having the 10%. We can figure out what that math is going to look like. As rates start to come down in the next year on regular mortgages, you know, if we start to see VA rates, you know, back into the 4 point somethings, it will be important to do the math on just a brand new VA loan versus assumption plus a second. There was a couple scenarios that I ran into before rates really jumped up into the 6s and 7s, and it was almost a push. It was almost even Steven getting just a brand new VA loan versus the assumption. So as rates come down, it'll be important to just compare the math on that and have an idea of where, you know, VA rates are at the time. It may save some heartache to not have to go through the assumption process if that lender is just a pain in the neck and super slow. And for those who are not in a position where they're going to get some windfall of money, right? They're not in a commission environment. They're not selling a property or anything like that. Then when rates do dip, it might just be smarter and better financial advice for them to take out a new mortgage at 4 point whatever, rather than assume a 2 point and then get a 14%, you know, because your combined interest rate there is quite a bit higher. And if they elect for the equity line and they're not in a position where they're going to get chunks of money, the equity line could bite them down the road. So just kind of keep that, you know, on the top of your mind as we enter into a period where, you know, hopefully interest rates are going to dip back down, and the prediction is VA rates will be back into the 4s, maybe mid to high 4s. Send me all your loans. Send me all your buyers. Let's get some more in escrow. Let's kick butt and be partners this next year. Thanks, everybody.